The world of money is changing faster than ever before. If you feel like the old rules don't apply anymore, you are absolutely right. The strategies your parents used to build wealth, like putting money in a savings account and just letting it sit there, are no longer enough. In fact, following that old playbook today is a guaranteed way to lose purchasing power year after year. This isn't meant to scare you, it's meant to wake you up. We are living in an era of incredible opportunity, but only for those who understand the new game. The chance to build real, lasting wealth has never been more accessible, but it requires a new way of thinking and a new set of simple, actionable habits. So, what has changed? The big villain in this story is something called inflation. Think of it as a silent tax that slowly eats away at the value of your cash. That dollar you tucked away last year buys you a little bit less today. When prices for everything from gas to groceries are creeping up by a few percent each year, your money sitting in a standard bank account earning maybe 0.5% in interest is actively losing its power. It's like trying to run up a down escalator. You're putting in the effort to save, but you're still moving backward. This simple truth is the most important financial concept you can grasp in 2025. This reality means that saving money is no longer the end goal. Saving is simply the first step. Investing today is fundamentally different than it was even a decade ago. It's easier, cheaper, and faster than ever before, which is a massive advantage for anyone starting out. Gone are the days when you had to call a stuffy stockbroker in a suit, pay him a huge commission, and buy a minimum of 100 shares of a company. That old world created a massive barrier that kept most everyday people out of the market. Today, that wall has been completely torn down by technology. You can now download an app, connect your bank account, and buy a piece of your favorite company all from your couch in less time than it takes to order a pizza. The biggest game changer is the reduction in fees and the introduction of fractional shares. Brokerage firms now compete to offer zero commission trades, meaning it costs you nothing to buy or sell a stock. This is huge. Previously, fees could eat up a significant portion of your investment. Furthermore, fractional shares allow you to buy a small slice of a company. You don't need $3,000 to buy one share of a major tech company. You can invest just $5 or $10 and own a tiny piece of it. This opens the door for everyone to start building a diversified portfolio. At the same time, the economic environment has become more complex and fast-moving. We live in a globally connected world. New technologies like artificial intelligence, blockchain, and clean energy are creating new industries while disrupting old ones, bringing opportunities and risks. A diversified, adaptable approach is more important than ever in this double-edged landscape. Build habits. Start small, be consistent, diversify, and ignore the noise. The single most powerful tool you have as an investor is time. It's more powerful than a large starting sum, more powerful than a genius stock pick, more powerful than any complex trading algorithm. This is because of a magical concept called compounding. Compounding is when your investments earn a return, and those returns start earning returns too. It's a snowball effect for your money. A small amount given enough time can grow into a surprisingly large sum. Starting now, today, 2025, maximizes that time. Many people delay because they wait for the perfect moment, waiting for the market to dip, waiting for their next raise, waiting until they've read every book. That's a huge mistake. Trying to time the market is a fool's errand. Pros fail at it too. The best time to start was yesterday. The second best time is right now. Every month you wait is a month of lost compounding. Start small now, better than planning to start big later. Another common fear, losing money. That's understandable. Yes, investments can fall in the short term. Markets have ups and downs. That's normal. But the risk of not investing is real. Inflation guarantees cash loses value over time. By not investing, you accept a certain steady loss each year. Invest smartly. Start with an amount you're comfortable with, $25 or $50 a month. Don't put all your eggs in one basket. Take a long-term perspective, 20 plus years. Long-term investing makes short-term swings less terrifying. You have time to recover and let the market's upward trend work for you. Your first step isn't expertise, it's getting in the game. Once you're ready to start, the question becomes, where do you actually put your money? The options can seem overwhelming, but for a beginner, you only need to understand a few key categories. The simplest and, for most people, the best place to start is with index funds or ETFs. Think of an index fund as a big basket that holds tiny pieces of stocks, hundreds or even thousands. For example, an S&P 500 index fund holds shares in the 500 largest US companies. This gives you instant diversification. You're not betting on just one company to succeed. The beauty of index funds is their simplicity and low cost. They're passively managed. They just track a market index. That's why their fees are incredibly low. High fees are a silent killer of investment returns over time, so keeping them low is critical. For most people, regularly investing in a broad market index fund, like one that tracks the S&P 500 or the total stock market, is the single best way to build long-term wealth. It's a set it and forget it approach that has outperformed most professional managers long-term. Beyond index funds, you might consider individual stocks. Buying a stock means buying a small ownership stake in one company, Apple, Amazon. The potential rewards can be higher if you pick a big winner. However, the risk is much, much higher. A single company can face unexpected problems or even fail. If you buy individual stocks, only invest in companies you understand and keep them a small speculative slice. Real estate can be great, but takes capital and effort. A simpler way is REIs, funds that own properties and trade like stocks. Then there are newer, volatile assets like cryptocurrencies. They are highly speculative and can swing wildly. Treat crypto like a trip to Las Vegas. Only risk what you'd be fine losing. For a beginner, keep your core in low-cost, diversified index funds. Investing is not just about growing your money. It's also about protecting it. Building wealth is a marathon, not a sprint. And a few simple defensive moves can keep you from being knocked out of the race. The very first step before you even invest a single dollar is to build an emergency fund, cash separate from your investments that covers 3 to 6 months of essential living expenses. Keep it in a high-yield savings account where it's safe and easily accessible. Your emergency fund is your safety net. It ensures that if you lose your job or have an unexpected medical bill, you won't be forced to sell your investments at a bad time. The second key is dollar cost averaging, or DCA. It just means investing a fixed amount on a regular schedule regardless of what the market is doing. When the market is high, your $100 buys fewer shares. When the market dips, your same $100 buys more shares. Over time, this averages your price and reduces risk. Automation removes emotion and guesswork. Diversification is your third shield. Don't put all your eggs in one basket. Spread money across hundreds of companies, different industries, and even different countries, which is exactly what an index fund does. The failure of one or two companies will have a very small impact. Diversification smooths out the ride. Finally, your mindset. Fear and greed tempt bad decisions. Create a simple plan. Avoid emotional choices. Tune out the daily noise. Trust your long-term strategy. And let time and consistency do the heavy lifting for you. So, stick with the plan. And let patience work for you. Section 6, avoiding the sirens call. Common mistakes that sink beginners. The path to building wealth is littered with common traps, especially when you're just starting out. One of the most dangerous mistakes is chasing hype. News, hot stock doubled. Friend raving about a new cryptocurrency going to the moon. This is called FOMO, the fear of missing out. By the time you hear about it, the big gains likely already happened. You're buying at the peak. Successful investors don't chase hype. Trying to time the market is the cousin of hype chasing, the belief you can sell tops and buy bottoms. The reality, nobody can do this consistently, not even experts with supercomputers. People who try to time it often end up selling low out of fear and buying high out of greed. Stay invested through the ups and downs. You're there for the best days, which often follow the worst ones. Not paying attention to fees is a silent portfolio killer. A fee of 1% or 2% might not sound like much, but over decades, it can consume a massive chunk of returns. Imagine you and a friend both invest $10,000 at 7% for 30 years. You choose a low-cost index fund 0.04% fee. Your friend chooses an actively managed fund 1% fee. After 30 years, you have about $75,000. Your friend has about $57,000. That fee difference costs them nearly $18,000. Finally, letting emotions drive decisions is a huge mistake. Your brain isn't wired for investing. Best fix: automate your investments. Set up an automatic monthly transfer. This automates dollar cost averaging and forces consistency. Automation is the best antidote to emotional decision making. Section 7, the millionaire mindset, thinking like a long-term winner. Building wealth is more about psychology than finance. You don't need to be a genius to succeed. You need the right mindset. Adopt a long-term perspective. Investing is not a get-rich-quick scheme. It's get rich slowly and get rich surely. Think of it like planting a tree. You don't plant a seed and then dig it up every day to see if it's growing. Plant it in good soil. Water it regularly. Have the patience to let it grow over years into something strong and substantial. Your investment portfolio is that tree. Your job is to be the patient gardener. Consistency trumps intensity. Someone who invests $100 every month for 30 years will almost always end up wealthier than someone who invests $10,000 once, tries to time the market, then gives up after a few years. Embrace the marathon. There will be years when the market is down and it feels like no progress. These are the most important times to stay consistent. Be a lifelong learner, but value simplicity. Stay informed, read books, listen to reputable podcasts. But don't think you need a complex strategy. Complexity is often the enemy. A simple plan you can understand and stick with is far superior. For 99% of people, regularly invest in low-cost, diversified index funds for decades. Change your relationship with money. Start seeing it as a team of employees. Every dollar you save and invest is a little worker. Get that worker a job, an investment, then hire more workers. Compounding. Build your financial army that will one day work for you, giving you freedom and security. Section 8, your simple blueprint. A step-by-step plan for your first investment. Theory is great, but action is what builds wealth. Here's a simple step-by-step blueprint you can follow starting today. Don't try to do it all at once. Focus on one step at a time. Flowchart. Pay off debt, emergency fund, open account, automate investments, review annually. The first step, pay off any high interest debt like credit cards. Rates are often 20% or more. No investment reliably beats that. Eliminate it first. Step 2, build your emergency fund. It's your financial firewall. Open a separate high-yield savings and save at least 3 months of essentials. Automate a transfer every payday. That buffer lets you invest long-term without panic. Do not skip this step. It's the foundation of your financial house. It allows you to invest with confidence instead of fear. Step 3, open a low-cost brokerage account. Fidelity, Vanguard, Charles Schwab. Consider a Roth IRA or a standard taxable brokerage. The process is online in about 15 minutes. Choose a reputable firm with low fees. Connect your bank. Step 4. Set up your automatic investment. This is where the magic happens. Decide an amount you can invest each month, even $50. Inside your brokerage, find a broad, low-cost index fund, Total Stock Market Index Fund, VTI, VESROX. Then schedule an automatic monthly buy on the same day each month. This puts your strategy on autopilot. You are dollar cost averaging into a diversified portfolio without having to think about it. This is the single most effective action you can take to build long-term wealth. Section 9. Don't wait for perfect. Your future self is counting on you. We've covered a lot of ground, but it all boils down to one simple message. The time to act is now. The world of money has changed, and the old ways won't secure your future. Inflation is a constant headwind, and the only way to overcome it is to put your money to work. So the tools have never been more accessible and never been more affordable. The excuses Too expensive, too complicated, too exclusive are gone. The only thing left standing between you and a wealthier future is the decision to begin. Don't let the pursuit of a perfect plan stop you from starting a good one today. Your future self, the you that wants to buy a house, travel the world, retire comfortably, and have financial peace of mind, is entirely dependent on the actions you take right now. They are counting on you to take the first small step. They are not expecting you to be an expert, to time the market, or to pick the next big winner. They just hope you will plant the seed of that financial tree today so they can one day enjoy its shade. The cost of waiting is far greater than the risk of starting small. What is your one small step? Decide right now. Will you budget, open an emergency account, download a brokerage app, or set a $25 transfer? Pick one, just one. Do it before you close this page. That small action creates momentum, and momentum turns intentions into habits. You can build the future you want. The path is simple and proven. Pay off bad debt, save for emergencies, invest consistently in low-cost, diversified funds. Stay patient. Ignore the noise. That's the whole formula. Start simple, stay consistent, and give your money the one thing it needs most to grow: time. Your journey to wealth doesn't start tomorrow. It starts with your very next action. Go take it.